Debt sucks. By having it, you're willingly giving your hard-earned money to somebody else to help them achieve their financial goals. And wouldn't you rather have that money for yourself, for your financial goals? Absolutely. And even if you've made the choice to eliminate your debt, if you're paying higher interest rates on that debt, it can make it seem like it's going to take forever. So debt consolidation should certainly be on the table, especially if it can help you reduce those interest rates. And in today's video, we're going to go over the different options that you have to consolidate your debt. And by the end, you're going to understand what the best is for you, as well as what maybe the worst option would be for you as well. And we're going to go over those details right after this. Hey there, I'm Adam Hagerman, your financial coach, and if you're saying things like, with my income, I shouldn't feel this stressed about money, then you're in the right place. This channel is all about helping you better understand your money so you can use it as a tool to help you achieve financial freedom. And if that sounds like you, make sure you click the subscribe button below, as well as clicking on that bell to receive notifications as my weekly videos come out. And if you find this video helpful today, make sure you click the like button at the end so that we can share this with the people that need to hear it. Today, we're going to talk about debt consolidation, specifically the options that you have to consolidate your debt after you've addressed the reasons that you got into debt in the first place. And if you're not sure what I'm talking about right there, make sure you pause this video and check out this one right up here, because it's an important step that you need to take before you even consider consolidating your debt. So if you've taken that pledge to never accumulate debt again, debt consolidation can certainly help you in a number of ways. It can help you reduce your overall cost of your debt, reduce your interest rate. It can help minimize your payment to maybe get back on track if you're behind on bills, etc. And it may also help you relieve some stress so that you don't have 15 different creditors. You now just have 2 or 3 or maybe even 1. So it's going to help relieve some of that stress too. So let's go over the options that are available to you for some debt consolidation. First up are personal loans. These offer a lower interest rate, fixed monthly payments, no collateral, as well as no access to a line of credit, which may be good for you if you're still having problems with spending and may accumulate some more debt. So not having access to a credit line could certainly be helpful. And to apply for a personal loan, certainly look at your bank or credit union, whatever you're using. There are certainly some online banks out there like SoFi, Credible, Upstart, many different ones out there available for you. And just be aware that you usually have to have a pretty good credit score in order to get these, since you're not having to put up collateral for them. So if you've already got a poor credit score, this may not be a helpful option. Another option is credit card balance transfers. This is where you can take current balances that you have maybe on some other credit cards and transfer them to another credit card that maybe doesn't have a balance on it to get a lower interest rate. Just be aware that if you already have multiple credit cards and really high balances are maxing some of those out, it may be difficult to be able to get another credit card to be able to transfer these different balances to. Most of these transfers come with a fee of about 3 to 5% of the balance that you're transferring, so just make sure that it's worth the cost. If you have a credit card with a balance on it and you're paying 15-20% on that balance, that's an annual rate, but if you can pay off that credit card within a very short time period, just a few months, transferring it to another card, even if it has a lower interest rate, may not be worth the upfront cost of the balance transfer. So make sure you kind of look at some of those numbers a little bit first before just assuming that doing a balance transfer is going to save you money, just again due to those high balance transfer fees. Another popular option is a home equity loan or a home equity line of credit. And if you're lucky enough to have equity available in your home to be able to take something like this out, you may be getting one of the lowest interest rates out there available to consolidate your debt. But the reason that you're going to get that lower interest rate is because that you are now putting up some collateral in association with that debt. If you're transferring money from a credit card onto a home equity line of credit, you are transferring unsecured debt to secured debt. So that credit card company, if you didn't make your payment on that credit card, they're not going to come back and take all the crap that you bought with that credit card to accumulate that debt. But if you transfer that balance from that credit card to that home equity line of credit or home equity loan, and you stop making a payment on that, your house is now at risk. So you need to be very, very careful when it comes to these products. There could also be fees associated with home equity loans or home equity line of credits because you may need to get an appraisal on the house to make sure that it's valued at what you think it's valued at, and there may be other closing costs as well. Also be aware that home equity line of credits usually start out as an interest-only type of option. So while they may say the minimum payment is a very small amount in comparison to what you had been paying on all the other debt, you may not be getting anywhere then in eliminating that debt. So make sure that you're paying extra on that debt as well to ensure that you're going to be paying it off. Another option could be available if you have a qualified employer-sponsored retirement plan at your work, like a 401k or a 403b. You may be able to borrow money from that, tax-free. You're borrowing your own money and paying yourself back into that retirement plan. And again, that could be an option that you use to consolidate some of your debt. Please note that I am not talking about withdrawing money from these accounts. And I'm also not talking about IRAs, individual retirement accounts like a Roth IRA or a traditional IRA. If you withdraw money from these types of accounts, your 401k, 403b, again, not a loan, we're talking about loans, but if you are withdrawing money from those accounts, you may be subject to income tax as well as penalties on top of that. And sometimes in total, that can be anywhere from the 30 to 40 to 50% range. So you might have to set aside 30 to 40, 50% of that money that you're withdrawing in order to pay the income tax liability that's going to come with that. So withdrawing from these accounts is not an option that I normally recommend, but a loan may be okay if you know some of the details that come with it. So these 401k loans do not require a credit check because you're simply borrowing money from yourself. But they're not something that I recommend to a lot of clients just because of the risks that are associated with these types of loan. And the biggest risk associated with it is the fact that if you left your employer, whether voluntary or involuntary, at some point in the future and still had this loan, in many cases that loan may become due immediately, which means that if you can't pay it off in full within usually a 60-day time period, it becomes a distribution or a withdrawal. And now we're going back to that possibility of paying huge amounts in taxes as well as penalties on that money that you're withdrawing. And you're also taking money out of that account, which means that you're taking it out of the stock market in investments, which is really going to possibly hurt your retirement prospects at some point. So again, last resort is usually what I talk about here. I rarely recommend that to clients. And if you do if you are considering that, make sure you talk with a financial counselor before you actually pull the trigger on that to ensure that it's the best option for you. The last option we'll talk about before getting into some things to avoid are debt management plans. And debt management plans are usually offered by nonprofit credit counseling agencies. And how they help you is that they work with your creditors to reduce your interest rate, possibly reduce your payments, and stop late fees and things like that. And what you do then is you make a one-time, or not a one-time, but a monthly consolidated payment to this debt management plan, who then distributes the money to your creditors that they've negotiated with on your behalf. And what they do then with this unsecured debt is that they try to help you pay it off within a 3 to 5 year time period. And there may be some small hits to your credit here, but FICO actually says, Fair Isaac Corporation, the one that does the FICO scores, credit scores, have said that this doesn't really affect. There may be a notation on your credit report, but it usually doesn't affect your actual credit score. The credit counseling agency does charge a monthly fee for this because they are, again, distributing those funds for you. And if you are looking for a company to help you with this, go to nfcc.org and you can search for some debt management companies, some debt management plans in your area. Now, there are certainly some products and services that you should avoid. First is a debt settlement plan. Not to be confused with a debt management plan that we just talked about. A debt settlement plan is where you work with a debt settlement company who essentially has you pay money to them. They hold that money then in escrow into an account with your name on it. And what they tell you to do is they tell you to stop paying on your unsecured debt. So stop making payments to your credit cards. And those will become late, 60 days, 90 days late, 120 days late. And what that debt settlement company then will do is take that lump sum of money that you have accumulated over several months and try then to negotiate your debt settlement and pay for your debts for less than what you actually owe. But what you need to understand is that because all those debts that you have now are going late, your credit score is going to be obliterated, and it's going to take a long time to recover for that. Yes, you may end up paying less than what you actually owe on all of those debts, but it's going to destroy your credit, and you may be able to even call your creditors on your own behalf to see if there's anything that they can do. Or again, go back maybe to that debt management plan where that company may be able to negotiate on your behalf. You should also avoid payday lenders. While they seem like an attractive option because they don't essentially have an interest rate, they just charge a fee to get you that loan. These fees, if you look at them, they've done the math. Some nonprofits and things have done the math on some of these payday lenders. You would find out that annual interest rates on these things, if you counted those fees as an interest charge, are in excess of 400% annualized. A lot of people get into payday loans and then actually get stuck and can never get out of them. So avoid those payday lenders at all costs. So now you've got several options to check out. And before you go applying for everything under the sun, do realize that everything that you apply for may ding your credit a little bit. So make sure you do your research and find out what the best option is for you, and then also what company it is that you want to go with. As a final reminder, none of these options are meant to be a quick and simple solution. There's a lot of work that needs to be done financially on your part outside of just consolidating your debt. You need to understand your money, you need to set those financial goals, you need to create a budget that is realistic and you're going to stick with. If you found this video helpful, please click the like button below. YouTube thinks you're going to like this video right over here. It's another one of me, so I'm sure you'll have fun watching it. And I'll just leave you with this. Remember to take care of your money so it can take care of you later. We'll see you next time.